Have you ever wondered how the stock market works? It's a question that has intrigued many for ages. It is a complex system where shares of publicly traded companies are issued, bought, and sold. Like a bustling marketplace filled not with fruits and vegetables, but with stocks and bonds. This digital realm is where fortunes are made and lost on a daily basis. How does this all happen, you ask? It all starts with companies wanting to raise capital. They do so by issuing shares, which represent a tiny ownership stake in that company. These shares are then bought and sold on the market, with their prices fluctuating based on a variety of factors, such as the company's financial health, the economy, and investor sentiment. This is where our investing public comes into play, those who buy these shares in hopes of benefiting from a company's growth or receiving income in the form of dividends. But, you see, not everyone ends up making money in the stock market. Some people seem to have a knack for it, understanding the trends and patterns that let them buy low and sell high. These individuals may have spent years studying the market, learning its intricacies, and formulating strategies that guide their buying and selling decisions. On the other hand, there are those who struggle, who buy stocks without understanding the market, driven by emotion rather than logic. They often end up losing money, victims of a volatile market they did not fully understand. And this is why we're here today. To delve deep into this world, to explore the strategies used by successful investors, to understand the market's volatile nature and how to navigate it, to shed light on the often confusing jargon, the intricate graphs, and the plethora of information that can be overwhelming for beginners. Today, we delve into the realm of stock market strategies to help unravel this financial enigma. Firstly, understanding the market is crucial. It is akin to venturing into the depths of a foreign land. You're not only learning a new language, you're also immersing yourself in a unique culture, learning its nuances and intricacies. Just as you delve into the grammar, idioms, and vocabulary of a new language, you need to familiarize yourself with the peculiar terminologies of the market. Terms like bullish, bearish, IPO, dividends, and equity are not just words, they are the lifeblood of market comprehension. They form the vital pillars that uphold your understanding of the financial world. Bullish and bearish are indicators of market sentiment. They guide you in gauging the health and potential trajectory of the market. IPO, or initial public offering, is a term that signifies the birth of a company into public trading, a crucial moment that can alter the landscape of the market. Understanding dividends is like understanding the reward system, the gains one can expect from investment strategies. Equity, the ownership interest in a company, is perhaps one of the most fundamental concepts, the very essence of the stock market. By comprehending these terms, you can gain a profound understanding of the market dynamics. Mastering this language can not only help you decipher market trends, but it empowers you to traverse the volatile terrain of the market confidently, arming you with the tools to make informed and beneficial decisions. It's the crucial first step in your journey towards financial literacy and success. Mastering this language can help you decipher market trends and make informed decisions. Next, remember this vital and golden rule. Diversify your portfolio. It's a principle that seasoned investors swear by. The concept is a simple yet profoundly effective one. Avoid concentrating all your investments into one category or sector. Think of it as not putting all your eggs in one basket, a metaphor that perfectly encapsulates the essence of diversification. The reason behind this is twofold. Firstly, since different sectors and industries often perform differently under varying economic conditions, spreading your investments across them helps reduce the adverse impact of a single sector or industry doing poorly. Secondly, geographical diversification is also crucial. The economic situation can vary greatly from one region to another, and what is booming in one area might be struggling in another. Diversifying geographically can potentially cushion the impact of a downturn in any one location. This approach to investing is not about chasing the highest returns, but rather about mitigating risk. It hinges on the understanding that not all investments will perform equally well at the same time. Some might be up and others might be down. But having a diversified portfolio can mean that when one investment doesn't perform well, others might still yield returns. By dividing your resources, You can better manage potential losses and optimize your potential for returns. Diversification does not guarantee profits or protect against losses in declining markets, but it does provide the potential to improve returns for the level of risk you're willing to accept. This way, if one investment doesn't perform well, others might still yield returns. Now, on to the third strategy, patience. The stock market is not a place where immediate wealth is amassed instantaneously. It is not a sprint, but rather a marathon. It may be tempting to expect quick returns, to anticipate that your initial investment will double or even triple in a matter of months or even weeks. However, such expectations are not only unrealistic, but can often lead to hasty decisions, ill-informed risk-taking, and ultimately financial loss. In fact, the stock market is a grand chessboard where strategic moves, patience, and timing are of the essence. It's a world that thrives on the principles of long-term growth and potential return. It is a game that requires skill, knowledge, and above all, patience. Patience matched with consistent and regular investments can be the key to unlocking substantial growth over time. It's not about making a quick buck tomorrow, but about planting seeds today that bear fruit in many tomorrows to come. The true power of investing lies in the magic of compound interest, the financial phenomenon of earning interest on your interest. This is where your money starts working for you. You invest, that investment earns interest, and then that interest earns more interest. It is a cycle that, when maintained consistently over a long, can lead to exponential growth. It's about understanding the market cycles, riding out the downturns, capitalizing on the upswings, and keeping a level head throughout. It's about making informed decisions, not rash ones. It's about long-term vision, not short-term gains. Over a long period, this can lead to exponential growth of your investment. The fourth strategy is to stay informed. A lot of individuals may underestimate the importance of this, but it's absolutely crucial. To stay informed means to be abreast of all the happenings in the financial market. It's about being consistently aware, constantly in tune with the ebb and flow of the economy. What we're effectively talking about here is keeping a vigilant eye on financial news, whether it's through newspaper articles, online reports, or televised broadcasts. This can range from checking the daily stock market numbers to reading in-depth articles about market trends. When you delve into such informational sources, you'll find that your understanding of financial matters expands, and you begin to see the bigger picture. Speaking of market trends, these can offer a wealth of information. These trends could be a shift in consumer habits, changes in economic policies, or even global events that could potentially impact the market. Understanding these trends means comprehending the subtle shifts in the economic landscape that could open up new investment opportunities or highlight potential risks. Knowledge, as they say, is power, especially in the world of investment. This is an arena where the well-informed often have the upper hand. They are the ones who can make calculated decisions based on solid information and analysis rather than mere speculation or gut feelings. The key point to remember here is that it's not about reacting to the market, but being proactive. It's about foreseeing potential changes, planning for them, and being prepared to make the necessary adjustments to your investment strategies accordingly. It's about being proactive, not reactive. Finally, and perhaps most vitally, don't let your emotions lead your decision-making process. It's quite easy to fall prey to the whims of the market, and that is a pitfall you need to avoid. Many investors, both seasoned and novices alike, often find themselves taken aback by the sudden and unpredictable movements of the stock market. When it dips, it's not uncommon for a wave of panic to wash over you. You find yourself gripped by fear, unsure whether to hold onto your stocks or sell them off at the first sign of a downturn. Similarly, when the market surges unexpectedly, it can kindle a spark of avarice in your heart. You may find yourself wanting more, eager to invest more, hoping to ride the wave of success to unprecedented heights. Yet you must not let these of greed cloud your judgment. It's important to remember the stock market is cyclical in nature. It has its ups and downs, much like the ebb and flow of the tides. Success is not linear. It does not follow a steady, unbroken path. Rather, it is a series of peaks and troughs, of highs and lows. You might experience exhilarating highs one moment and crushing lows the next. Making decisions based on emotions, whether it be fear, greed, or something else entirely, can lead to hasty and often regrettable decisions. It's crucial to stay calm, to remain composed, to not let your emotions get the best of you. After all, investing is not simply about making money, it's about making smart, informed decisions. Lastly, and perhaps most importantly, don't let emotions guide your decisions. So, to recap one, understand the market and its language. This involves comprehensive research into the primary trends, changes, and shifts that impact the industry over time. It requires a deep dive into the various terminologies, abbreviations, and jargon are unique to the world of stocks and trading. The more knowledge you have, the better equipped you are to make smart investment decisions. 2. Diversify your portfolio. The idea behind diversification is to spread investments across a variety of assets, thus reducing the risk of losses. For instance, you can invest in stocks, bonds, mutual funds, and real estate. This strategy is considered one of the cornerstones of sound financial planning. 3. Practice patience and invest regularly. Consistent investment over a long period can generate substantial returns due to the power of compound interest. It's essential not to be discouraged by short-term market fluctuations and remain patient. 4. Stay informed about financial news and market trends. Regularly checking financial news sources and being aware of global economic events will keep you updated on market trends. This information can be extremely valuable when making investment decisions. 5. Keep emotions in check and make rational decisions. It's crucial to avoid letting emotions drive your investment decisions. Regardless of market conditions, always make objective, informed decisions based on solid financial data. Mastering the stock market isn't about predicting its every move. It's about understanding its nature, being patient, and making informed decisions. It's about strategy. And with these strategies, you're well on your way to building wealth in the world of stocks. Remember, the journey to wealth is a marathon, not a sprint. So gear up and enjoy the ride.